You see a stock trading at a 90% discount and think you found a deal. I see a trap. Because here's the truth. It's far better to buy a wonderful business at a fair price than a fair business at a wonderful price. Cheap is tempting, but quality is what builds real wealth. I'm Warren Buffett. Early in my career, I hunted for cigar butts, companies so cheap they had one last puff of value. But I learned a better path. A path that doesn't rely on buying bad businesses cheap, but rather great businesses at reasonable prices. That's how you get compounding to work for you, not against you. Part 1: The myth of cheap stocks. Cheap doesn't always mean undervalued. It can mean broken. A company might look like a bargain because the stock is down 80%. But ask yourself, is it profitable? Is its moat shrinking? Is it dying a slow death? You don't want to own a business that's circling the drain, no matter how cheap the price tag. Part 2: Wonderful businesses compound wealth. Now, a wonderful company? That's a different story. It earns consistent profits. It has a durable competitive advantage. And most importantly, it can reinvest those profits at high returns. Take Apple. I bought it when it wasn't the cheapest stock around. But it had loyal customers, pricing power, a strong ecosystem, and room to grow. The result? Compounding. See's Candies was the same way. I paid a premium compared to what I used to, but it made consistent returns year after year. That's a wonderful business. Part 3: The trade-off. Price versus quality. Let's say you have two choices. A decent company selling for half its book value. A great company selling at 20x earnings. Most people pick the cheap one. But here's the problem. If the business can't grow, you'll be stuck. The great company, even at a fair price, will keep growing, reinvesting, and compounding. Over time, the gap becomes massive. That's why I say, price is what you pay. Value is what you get. Part 4: When to pay up. So when should you pay up for quality? When the business has checkmark consistent earnings, checkmark strong brand or moat, checkmark long runway for growth, checkmark smart capital allocation. If you find all that, and the stock isn't insanely priced, buy it. Because wonderful businesses are rare. And the market only misprices them occasionally. When it does, that's your moment. Too many investors chase cheap stocks and end up owning garbage. But if you focus on quality businesses, even if you pay a fair price, you'll win the long game. So if this helped you shift your thinking, hit that like button, subscribe, and stay tuned for more. And remember, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price.